Have you ever played the game Clue? It's a board game, and the objective of the game is actually very simple. You have a crime committed, and you have to guess who committed the crime, what weapon they used, and what room in the building they committed the crime in. So my favorite was Colonel Mustard with the candlestick in the library. And if you get the right three, then you win the game. Simple enough, right? You think, what's this got to do with the Fed? For the last 6 years, it feels like we've been playing a giant game of market clue, where whatever the event in the market, interest rates are up, interest rates are down, stock prices are up, stock prices are down, the result is always the same. The Fed did it with QE in the bond market. We've used the Federal Reserve as our defense against everything in the market. We've obsessed about the Fed to the point that it's become the reason for everything, good or bad, that happens in the market. And I think that obsession has become unhealthy. In this session, I'd like to talk about 3 myths or misconceptions that I think are widely held about the Fed. The first is that the Fed sets interest rates, that somehow the Fed is responsible for what we see in the T-bond market, in our mortgage rates, and our bank CD rates. Second, that the Fed has been the primary factor behind why interest rates have been low for the last 6 years. That if it weren't for the Feds, rates would be much higher. Third, that it's those low rates that have been responsible for stock prices going up as much as they have for the last 6 years. And finally, that if the Fed acts now and changes its interest rate policy, the biggest thing it has to fear is that stock and bond markets will react badly. I think those are all 4 misconceptions. And let me explain why. Let's start with the notion that the Fed sets interest rates. I tell people this story. About a few months ago, my family and we went to the Federal Reserve building in New York City for a tour. And when the tour guide came up, I almost asked her where the interest rate room was. You know the one I'm talking about, right? The one where Janet Yellen comes in every morning and she's surrounded by these levers that she moves up and down depending on what she wants to say. I was trying to strike at the heart of what I think is this illusion that the Fed sets all these rates. We know the Fed sets one rate, the rate at which banks borrow at the federal window. It indirectly sets the Fed funds rate, the rate at which banks borrow and lend with each other in the Federal Reserve. It does not set any of the other rates. It is true that that overnight rate, the Fed funds rate at which banks borrow and lend, is connected to other really short-term market interest rates. But that's the extent of the direct connection. Everything else is implicit. Will the long-term bond market react positively or negatively to a Fed move? We don't know. The effect that the Fed has on long-term rates is much more tenuous than the effect it has on really short-term rates. And even those really short-term rates are set by the market, not by the Fed. Now let's move on to the second misconception, that rates have been low for the last 6 years because the Fed has kept rates low. Now let's start with the part of that statement which is true. Interest rates are at historic lows. The T-bond rate and the T-bill rate are at levels we haven't seen in 50, 60, 70 years. But has the Fed been responsible for rates being low? Is it QE1, QE2, the bond buying by the Fed, the fact that the Fed funds rate is close to, is that what's kept these rates low? Now, to answer that question, I went back to my Econ 101 basics. And I remember an equation called the Fisher equation that tied the nominal interest rates or broke it down into 2 components, expected inflation and an expected real interest rate. I did make a leap of faith. I assumed that the growth in real GDP is roughly a good approximation of the real interest rate, and I added up the inflation rate and the real GDP growth rate each year to come up with what I call an intrinsic risk-free rate. So in this graph, for instance, if you look at the bars, those are my intrinsic risk-free rates over time, estimated by adding the actual inflation rate and the actual GDP growth rate that year. Now, if you look at the graph, there's another line that I've superimposed there, which is the 10-year T-bond rate. And you can see the two move incredibly closely. When inflation and real GDP growth sum up to give me a high number, as they did in the 70s, interest rates have been high. And when they sum up to give me a really low number, interest rates have been low. And therein, I think, lies the answer as to why rates have been low for the last 6 years. If inflation is non-existent and growth is anemic, you should expect rates to be low, with or without the Fed. I'm not saying the Fed has had no impact, but the primary reason interest rates have been low is not because of the Fed's actions, but because the Fed's actions have, in a sense, not worked. Now, if you follow through to the next misconception, it is that those low rates have been responsible for high stock prices. Sounds reasonable, right? If rates drop, that must make stocks more attractive. But let's see if that's in fact true. There's a simple way to test the proposition that low rates are why we've had this last bull market. The expected return on stocks is what investors demand for investing in stocks. And in 2008, that number was about 8.5%. I'm talking about a forward-looking estimate of what investors are pricing stocks to earn. 8.5%. The T-bond rate in 2008 was about 4.5%. The T-bond rate today is about 2%. If rates have been the primary reason why stock prices are high, here's what you should expect to see. You should expect to see the expected return on stocks have dropped to about 6 to 6.5%. Now, I've been estimating the expected return on stocks at the start of every month going back to September of 2008. And in 2015, in August of 2015, the expected return on stocks was not 6% or 6.5%. It was at about 8.5%, roughly the same level that it was in 2008. So interest rates can't be the primary factor that's keeping stock prices elevated. So you think, what's causing them to be so high? I think the answer is pretty straightforward. U.S. companies have been returning incredible amounts of cash in the form of dividends and stock buybacks. Part of the reason for this is profits are at historic highs. Operating margins are elevated, and companies are earning more than they historically have. They're also returning. Proportions of these earnings are unheard of. In 2014, for instance, U.S. companies returned about 91% of their earnings as cash flows, much higher than the 80 to 85% you've seen in the last decade, or the 75 to 80% you'd have seen prior to that. So the high earnings plus high cash flow return have translated into very large cash flows to stock investors. That, in my view, is what's kept stock prices elevated, and that, in my view, is the biggest danger to stocks. It's not that rates will go up. In fact, in this table, I've estimated what will happen to stock prices if cash flows stay at current levels, but rates go up to 3, 3.5, 4, 4.5, or even 5%. And if cash flows stay at what they are, if interest rates go up, stock prices drop by relatively modest amounts, less than 10%. It's a drop in cash flows that will be dangerous for stocks. If earnings decline, or if companies return less cash than they did in 2014, go back to 80 to 75% of the earnings being returned in cash flows, you're going to see a cash flow impact. That's what we should be talking about now, not whether the Fed will raise rates or change its interest rate policy a week from today. Which brings me to my final misconception, which is that if the Fed changes its interest rate policy, the most dangerous thing, the worst thing that can happen is that stock and bond markets will behave badly, that they will collapse. I'm going to suggest something that is out of the norm. I'm going to argue that there are two other scenarios that are far more dangerous. The first is that the Fed acts, changes interest rate policy, and markets do nothing. Bond markets stay flat, interest rates don't change, and stock prices don't collapse. That's dangerous, and I'll talk about why. The other is the Fed does not act, and interest rates go up anyway. In other words, the Fed doesn't change its interest rate policy, but rates climb back up to 4, 4.5, 5%. Why? Because inflation goes back up, or real growth comes back. Both of those scenarios are dangerous, and here's why. The Fed has affected interest rates at the margin in the US for the last 60 years. It would be silly of me, naive of me, to argue that there's no Fed effect. In fact, I can estimate the Fed effect by taking the difference between the T-bond rate and my intrinsic risk-free rate that I computed earlier. And if you see that orange band here, that's been the Fed effect in the US. Historically, the Fed's affected rates, not because it sets rates, but because it has credibility backing it up. What am I talking about? When the Fed acts, investors assume it's acting because it sees something in the economy, that it's lowering rates because it sees economic weakness, it's raising rates because it sees economic strength. And the Fed, as long as it acts consistently, will have credibility. What's kept the Fed effective in the US is it has been independent and credible. And the biggest danger to the Fed is anything that attacks that notion. And to me, both those scenarios that I just described could be dangerous. And here's why. If the Fed acts by changing acts in the sense of changing interest rate policy and nothing happens in the markets, that's dangerous, because investors are going to wake up and say, hey, you know what? We thought the Fed set interest rates, but it doesn't seem to. If the Fed doesn't act and interest rates go up, you'll have exactly the same problem. Investors are going to wake up and say, hey, the Fed doesn't have that much power. In fact, the story I like to tell is the story of Chanticleer. It's about a rooster. And so the story is several hundred years old. So in this story, the rooster essentially crows at the start of every day as the sun comes up. And all the other barnyard animals pay heed to it, because they think that it's the rooster's crowing that's causing the sun to come up. Then one day, for whatever reason, the rooster doesn't crow, and the sun comes up anyway. And the other barnyard animals wake up and they realize it wasn't the rooster that caused the sun to come up, that the rooster just sang as the sun came up. The rooster lost its power on that day. The Fed has to worry about its own version of the sun rising when it's not crowing. And that's what interest rates are here. So on that note, let me leave you with my parting thoughts. We don't know what's going to happen in a week. We don't know whether the Fed's going to change interest rate policy or not. We don't know what will happen to the bond market when it does. And don't believe anybody who claims to say, who says that they know exactly what's going to happen. And we also don't know how equity markets are going to react to the Fed acting. But having said all of that, I think that the best thing that the Fed can do is act and change its interest rate policy now and get this behind us. Because I think the more we obsess about the Fed, the less attention we're paying to the numbers that we should be paying attention to about earnings and cash flows. The obsession with the Fed has gone on long enough. Let's move on. Thank you very much for listening.